Good afternoon. I'm Marty Straka. I'm a mortgage loan specialist. I've been in the mortgage industry since 1990, helping clients all across the United States in getting their mortgages. And we're going to take a few moments now to answer some common questions that come up from clients during the mortgage and purchase process.
What is PMI and why is it required?
Well, PMI, which stands for Private Mortgage Insurance, is sort of like an independent company acting as a co-signer, if you will, on the loan. The mortgage lender really wants you to put down a minimum of a 20% down payment, and in some cases a 25% down payment, in order for that mortgage lender to want to lend you money for a mortgage. And you're saying, well, but I've got good credit, I've got good job, I've got good income, won't you work with me a little bit? And the mortgage lender says, well, here's what we'll do. We'll consider lending you more money, or with less of a down payment, provided that we can hire an independent company to help guarantee that risk. That's private mortgage insurance. Private mortgage insurance does not protect you. Private mortgage insurance protects the lender. If you default on this loan at some time in the future, the bank's going to come back and say, well, that's why we wanted more money down. So they're going to go to the private mortgage insurance to help protect them from some of their losses. Anytime that you're putting down less than a 20% down payment on a home, there's some format of private mortgage insurance usually involved on the loan.
What is the minimum down payment that you'd require in order to eliminate PMI?
Well, in most cases, it requires a 20% down payment. Now, there are certain exceptions to this rule, depending upon where the property is located and what the market economy is doing in that area. And in some cases, even some lenders will base it on a credit score. They may require 25% down. It also varies whether you're buying the house as a home you're going to live in as your primary residence, or if you're buying it as an investment property. But the general rule of thumb is as long as you're putting down at least a 20% down payment, 20% of the purchase price, you should be able to find financing for that home without requiring private mortgage insurance. An exception, whether you're getting an FHA loan or a VA guaranteed loan, regardless of the down payment, you should expect that there's going to be some sort of a mortgage insurance policy on those government insured loans.
Well, how long will I be required to have PMI on my loan?
Well, the minimum, by almost all standards, is a minimum of 2 years. And then after that, it's actually up to the lender and the private mortgage insurance company if they're willing to release you out. Now, every lender has private mortgage insurance guidelines that they can share with you. The general rule of thumb is as long as you've decreased the principal amount of that balance down below 80% of the original purchase price value of the home. In some cases, it's 78%. Eventually, that private mortgage insurance will go away on its own. And for most people, that typically takes about 7 years before there's enough down payment and principal reduction taking place that you're going to qualify for the elimination of that private mortgage insurance. You can accelerate that, and the lender may even require you to pay for an appraisal to verify the equity. That's something you need to talk with every lender because each individual policy is a little bit different.
How much does mortgage insurance cost?
Well, the mortgage insurance cost varies depending upon the amount of risk that's involved. If you think about it as a scale of justice or a scale of risk, okay, the more risk that you put into the transaction, the higher your cost can become. Things that will affect the cost of your private mortgage insurance are going to be what is your credit score. So how much of a good credit risk are you? How much of a down payment are you putting down on the home? If you're only putting down a 5% down payment, there's obviously a higher level of risk to the lender than if you're putting down a 15% down payment. Most mortgage lenders will be more than happy to share with you the exact cost differences depending upon your credit score and what your down payment is and how that'll affect your actual mortgage insurance cost.
Do lenders provide any alternative to mortgage insurance?
Well, there is what they call lender-paid mortgage insurance, and some lenders will offer that. In the case of a lender-paid mortgage insurance policy, what they're actually doing is they're typically requiring a minimum of a 10% down payment. And then rather than you paying an actual monthly fee for mortgage insurance, they're going to increase the interest rate up front on the loan a little bit and use that interest rate spread, or what they call a yield spread premium, to actually help offset the cost of the private mortgage insurance. Now, you might sit back and say, well, wait, if I can get a mortgage at 5%, why would I want to take a mortgage at 5.5%? The truth is, look at the numbers. In many cases, the mortgage payment on a home with a 5% interest rate and monthly mortgage insurance is actually higher than if you had just paid a 5.5% interest rate with no monthly mortgage insurance. Each person's situation is different and unique. Talk to your mortgage lender, but it's certainly worth researching about lender-paid mortgage insurance.
Well, that sounds really good, but if I have any more questions, is there a good way to reach you?
Well, I'm happy to answer your questions and certainly willing to help you with your mortgage application. My name is Marty Straka. The best way to reach me is on my cell phone. I cheerfully answer my cell phone every day, anytime after 7 a.m. and up until 11 o'clock in the evening. My cell phone number is 973-598-5006. I'm Marty Straka, and I'm looking forward to helping you.